Hello, investors. Welcome. Thank you so much for joining us today. I'm Destiny Fernandez, the marketing manager at Catalyst Funding. We hope you had a wonderful holiday season and are ready for a prosperous year ahead. I see quite a few new faces when we were checking out our registration, so welcome. May I start off by congratulating you for getting a head start on the new year, taking opportunities like this one to learn from industry experts and stay informed. Pat yourselves on the back because you're getting a head start. Before we dive in, I just want to remind you that this webinar is being recorded and you will get a copy emailed to you tomorrow. And we're also providing a giveaway item. Great way to start out your 2022. Just by joining us live, you have entered to win half off your hard money processing fee with Catalyst Funding. So one lucky winner. Stay on the call. We'll find out at the end. As always, if you have any questions, please write them into our question box and I'll read them at the end for our speakers to answer. And before we jump in, this webinar is intended to be helpful to you. We love sharing this information and keeping you on the up to date on the ever-changing market. However, Catalyst, our associates and guests are not liable for any investment decisions you make hereafter. Please always conduct your own due diligence before moving forward with a deal, or feel free to contact us and speak with one of our fully licensed loan officers. They are very helpful advisors and they will walk you through your individual deal and needs. Without further ado, let me introduce you to one of my favorite public speakers, coaches, and mentors, CEO and founder of the Total Wealth Academy, Steve Davis. Welcome, Steve.
Thank you. Appreciate it. Good to be here. Looking forward to a really, what I think is going to be a prosperous, I'm really optimistic about 2022. I'm excited to head into it. Total Wealth Academy members, I want to send a shout out to Catalyst. They have helped dozens upon dozens, if not over 100 of our members buy investment real estate, both for long-term rental and for flipping. They're an outstanding company, and I'm really honored to even be considered to be on this webinar with them because of their credibility. Our program is a mentoring program and a passive investing program for any level of real estate investing, single family, multifamily. We're doing, in other words, some people join our group that have never owned a piece of real estate before. Some people already have 5,000 units, literally. And our students are investing in everything from self-storage to obviously apartment complexes, commercial buildings. We're even moving into the RV park space. I'm excited to have, in fact, the event you're sponsoring next Thursday, the Catalyst is sponsoring next Thursday, we'll have Steve Burgess, who owns 5 of the most beautiful RV parks in the greater Houston area. And he will be talking about his next project. If you're not familiar with this guy, he wrote the book on apartment investing. It's an insanely good book. I read it, got to be 15 years ago, and forgive the bragging, but I literally made millions of dollars off of that book because I finally understood how apartments worked. I was so single family minded, and I thought the rules of single family applied to apartment. They don't. And that book opened my eyes. So I'm excited to have him here. Oh, by the way, that event is open to members of Total Wealth Academy and non-members. So anybody listening to this that would like to come hear that, just go to totalwealthacademy.com and it's /spotlight. totalwealthacademy.com/spotlight. We call it the Spotlight Night because we're spotlighting top investors from across the United States at that event. It's a free event. We will have cocktails and snacks, and it's from 6:30 to about 9 next Thursday. So everybody's invited to that. I think that's about it for what's going on right now.
And if I might say a couple things about Steve's organization that I think are unique, arguably the biggest thing is that if you want to be in almost any part of real estate investing, Steve and his team have excellent experiences, and they bring in other industry experts that are probably the best in Texas. And if you go there, you're going to have such a depth of experience that you can have every tool necessary to succeed. It's not guaranteed success because you have to put the effort in yourself. You have to study, research, make good decisions, but you're going to have every tool needed to succeed in any category of the real estate investment business. So that's why we like working with the people that are there. They also make sure that people are getting into good deals. We see that all the time. They really help mentor people, whether they're beginners or super experienced. So it's a fantastic organization. If you haven't checked them out yet, it's definitely something you should do.
Thank you, Wade.
Sure. Absolutely. Yeah, they have and the members that I meet with, they run the gamut. You'll have people that are ballers that have hundreds of properties, and you have guys that are just want to get started. So if you're not a member and you're considering it, you should definitely go to these events. This one in particular, it's a great way to get to learn the team. They always have a good time. And I was going to say the same thing that Wade did. Like, they have more diverse product offerings than just about anybody that I know of, right? They run from basic rental property to apartments to mobile homes to all kinds of stuff. So regardless of where you're at or what you're looking to get into, you should definitely go check them out. They're a great group.
Thanks, Jeff.
Yep.
And I'll add just one more thing. The very first half off hard money processing fee that we gave away was to someone that went to Steve's group meeting. It was their first time there, and they won. They did their first investment with us. They've continued to invest with us. They're a member of the group now. So it's a great organization. They really do provide a lot of information and guidance. And if you're that lucky winner today for the hard money processing fee, know that you can definitely get started if it's your first time.
Yeah.
And if you are new, like I said, we do have quite a few new registrants. I see these names every month, and now I've seen a lot of fresh names this month. So I just want to introduce you to our founder and CEO, Wade Comeaux. If you're joining us for the first time, Wade is the reason we're here today. He started his lending career in 1995, and he has worked with large companies and held titles such as president, executive vice president, and led teams of up to 14,000. He's a licensed real estate agent and active investor himself. So what he's sharing with you today is something that he's going to implement into his own strategy in 2022. Jeff Johnson is our director of lending. If you've worked with us, then you've probably worked with Jeff at some point, or you've met him at an event as well. Jeff manages all of our lending operations within Catalyst, and he provides excellent and reliable customer service. So if there's ever an issue or if you're ever concerned, you can always get in touch with Jeff and he'll help you out. All right. Oh, I muted myself. We'll go ahead and jump into the market update. I know that's why you guys are here, and I'm hurrying it too far. I'll pass the torch over to Wade. Do you want to take this one?
Sure. And
Okay.
I am going to slightly fact check you on the 14,000 employees. I really appreciate the kind words, but my largest group is 1,400. A little different,
I didn't read it right.
Just as you
A small army.
Nonetheless, I appreciate the kind words, Destiny, and thanks for the intro. Yeah, I want to talk a little bit about what we do for the people that do not know. So we are a one-stop shop for all of your real estate investment goals in the single family 1 to 4 space. It's very important. Steve has a lot of great other people that you can work with in other categories, but we think we provide a very unique value proposition in that single family 1 to 4 space for both hard money to purchase and repair, as well as a wide array of permanent financing options. And we are real estate lenders built by real estate investors. So we have a pretty large portfolio of real estate investments ourselves. We try to take that experience and help you succeed. We have 5-star average reviews across all social media platforms. And we offer both conventional and non-conventional long-term options. So if you qualify for the best pricing, we have great solutions there. And if you do not, we have very unique solutions, including some that go as low as a 500 FICO score on ability to buy and hold properties. Last thing I'll say is that we're doing a lot of new loans in 2 categories we're very excited about. Those are non-qualified mortgages for blanket loans, where you can take a significant amount of properties, maybe 20, 50, 100, put them into one loan with one easy payment, and at a very attractive rate and with very low fees. So if you have not heard about that yet, definitely check with us. And we also have some unique products in the Airbnb or short-term rental category. These are often difficult to qualify for because they're bigger mortgages, and there's some complexities with the debt service coverage ratio often required on those, but we have some that are very exciting, designed for that exact category. So if you're looking to buy a vacation rental that you want to rent out 90% of the time, and California, Colorado, Florida, whatever the case may be, we have excellent products to help you out in that category as well. But let's dive into the rest of the presentation.
So housing starts, and Steve, feel free to jump in whenever you feel the need to offer some knowledge or opinion. But so we track this just about every meeting or every webinar, and this is the number of housing starts, new builds, and I believe it goes all the way back to the 1960s. And I'm happy to see that it's trending upward. That is, the lack of available inventory is one of the biggest drivers of the run-up we've seen lately on prices. And if you've been on here before, I'm sure you've heard it, but if not, the last 10 years was the slowest 10-year period for new builds. There just were not any new builds going on in the last 10 years. So when you couple that along with the growing population, the millennials hitting the home buying age, and that is a huge group. I believe it's the hugest group in the current population. You're going to get these run-ups of massive price increases. There's just not enough inventory and there's too many buyers. So we do track this. Steve, I don't know if you have any thoughts on new construction, but this is something we look at to kind of see if when those deals are going to hit the market, if it's going to bring our prices down a little bit, or at least slow the growth.
What, do we have a prediction for the number that's coming up in 2021? I'm sorry, 2022. Sorry.
I have seen some of that data, Steve, and there's still not the capability from what I've seen to reach the peaks of production that have happened in other decades. Like as you can see in the mid 2000s, the numbers were greatly above. Looks like almost 50% above where we are today. Other decades, 70s, 80s, we're still not going to be able to catch up that quickly. I do think eventually it will. Another very telling thing about this chart, I looked up the total population in 1950. It was 151 million. Now it's 331 million, but we're building fewer homes. Like, wow. Something about that sounds preposterous, right? And we've been doing that for the better part of a decade. And I think it was this needed but overcorrection to the meltdown in 2007, 8, and 9, right? When all these builders got burned, everybody in real estate got burned, everyone really backed off of it, but we have not properly reacted to the current population numbers. And this is one of the big reasons that Jeff and I think a few other people believe, even though we have been building more homes lately and home prices have appreciated a crazy amount in the last 2 years, where we think that there's probably not room for a tremendous amount of reduction, a deceleration, yes, but a reduction in prices just because of these numbers, simple supply and demand. I don't know what your thoughts are on that, Steve, but that's kind of where we're looking at these statistics.
To me, what you're saying makes a lot of sense, but the concern that I always have is fear among the people. And I think the exuberance, and I'm going to use a harsh word, the stupidity that's going on right now, where people are going in and paying $20,000, $30,000 above asking price. I think in Austin, one house sold for $150,000 above asking price, and it was only a $500,000 home.
Wow.
That's got to end, where people wake up and go, look, I don't want to lose $150,000 the day I buy a house, which is what that family did. Even if the price goes up, they still lost that 150. So there's a point where people, they wake up and the fear hits. They don't want to be that person that loses money and it shuts down. So I think there's a correction. Do I think it's going to be a major correction like 7 and 8? No, nothing like that. but I think there will be a correction here in the next 12, 24 months as people wake up to the, again, stupidity of what's been going on.
I do agree that there has been irrational exuberance recently. There's no
Yes.
doubt about that. You see that with people. I think they get fatigued because they lose out on 4 offers in a row, and then they do something crazy, right? To your
That's
point.
it.
And then they're like, oh, I've got this extra 50,000 there, and we want to get into a house, and there's so few. Yeah, I do think that's driving a lot of the price, the averages that are out there. I can totally see what you're saying. All right, what's the next slide we have here? Okay, so this is a good article we found in Fortune, and it's going to keep the conversation on this going. It's called The Great Deceleration. The biggest jump in home prices is behind us, why housing appreciation will slow. And even the most confident people or most, I guess, optimistic people are definitely not saying that we're going to have what we had last year. Like there's not one prognosticator out there saying that we're going to have another 20% increase that I've seen. But this is it really covers about, I think, 7 different prognosticators, and it says that Zillow predicts an 11% home price growth in 2022, which is a big drop. Goldman Sachs up 12.6. Looks like let's see, Freddie Mac 7, Fannie Mae 7.9. Mortgage Bankers Association predicts a 2.5% drop. The loan model out of these selected that actually showed a drop, but it did show a 2.5% drop. A lot of the reason they're talking about that is a projected interest rate increase, which I also agree with. I think we've already seen the Fed come in and do 2 key things. They came out and said that they were going to, maybe 4 months ago, they were going to decrease the bond buying, and then they said they were going to cut that in half, which is basically producing the effort to produce more money. They're really reducing, putting more money into the system. They already projected interest rate increases in next year. So I think we're going to see that, and that just decreases the purchasing power that people have in a home, right? Because they can't afford as big of a home with a higher interest rate. So a lot of people definitely predicting a slowdown, and some people even predicting reduction, as it sounds like Steve may be as well.
I guess it's interesting to me how big a difference it is from Zillow's 11%. You know, if you look at the Mortgage Bankers Association 2.5 loss, that is 13.5% different than what Zillow's saying. 15.1% different than what Goldman Sachs. I've got to say the Mortgage Bankers Association may want to go back and redo their numbers.
Well, they may be the geniuses and the people who are standing out. Who knows, right?
I know it's going to be funny if they end up being right. Their crystal ball was better. But yeah, I do see it slowing. I think everything you said is accurate.
I do think it's interesting if you look down at the bottom there. So Fannie and Freddie, which I guess are more middle of the pack, are saying 7 and 8. But if you look at that, even if it's 8%, 9%, which is, save the MBA, a little more conservative than most, that's double what it's been since 1980. So like if you look at, everyone gets caught up in recency bias and what's been going on the last couple of years, but over the last 40 some odd years, a 4 to 5% increase is normal, right? So even though it's slowing down, it's still, by most estimates, it's going to be double what the norm is. So it's still a very, very robust prediction from most people, at least. I will see a year from now, it'd be pretty funny if we're sitting here eating crow with the MBA being correct.
Yeah, that would be funny. Freddie and Fannie, they've been pretty accurate in the past.
Yeah. They normally have pretty good models. That 7% might be right in that range. I do want to mention one other thing here. If you notice, September and October, it was a 0.8% month over month. So if you stretch that out annually, right, that's 10%. So we're already seeing a big drop. Most of that 20% year over year was before the last 2 months. So there's already a deceleration that I think everyone should notice, because if you're out there trying to flip houses, which a lot of people were, and they made a lot of money when they did it, thinking that there's going to be appreciation. That massive amount of appreciation will eventually end. It's not going to, I mean, there's nobody out there saying 20% again. And if you're buying homes to flip, depending on that significant appreciation, eventually the music will stop. And we'd hate to see anybody get that. That's very risky. Yeah.
Yeah. So this chart kind of is putting numbers to what we were saying on the previous one. This comes from S&P Dow Jones. And if you look at the left-hand side, it basically starts in 2000 and it's annual increase, right? Home price growth. If you look in the 2000s, you had that normal 5-7%. You had a nice run up in 06 and 07, like you know, obviously the crash hits, you see a massive drop. And then you see things start kind of normalizing until you get to 2020, 21, and then you just see this monster spike. So if nothing else, this chart should tell you we are in very unique times right now. So to assume, like you said, to assume that things are always going to be this way is definitely a mistake, and things should normalize at some point.
Yeah, I think, I'm not sure whether it was Wade or you, Jeff, that brought up the point that the flippers, they need to be going off of the real numbers, not the appreciating numbers.
Yep.
If you're going to flip a house, what is that thing selling for right now? And use that number. If you can push it, 3 months later, do so, but make sure the numbers work off the actual current numbers. That way, heads you win, tails you win. Because in 2007 and 8, so many flippers just got slammed. And it was from that exuberance and that it's always going to go up mentality. No, make sure the deal works either way. Heads you win, tails you win.
So I'm curious. So Steve, do you kind of teach your people how to analyze deals? Hey, this is a flip worth doing or not worth doing?
Absolutely. Yeah, I have members that email me or they call me and we work through the numbers together to make sure, and I have members that will take my advice and members that will do it anyway. And the wonderful thing about the market is the ones who are doing it anyway are winning, but if some changes come, the ones who are going to do it anyway may end up losing. And I don't want to see that happen, because once you burn your hand as an investor, it's scary to get back in the game, and you lose years of growth by doing a dumb deal. And then you're scared. You don't want that to happen. Make sure these deals are heads you win, tails you win.
Yeah, no, that's great advice. Base whatever your rules are, base those rules off of what's happening. Do not anticipate an extra 3, 4, 5%.
Also, Steve makes a great point. If you have invested in the past and you're on this call today, or you listen to a recording of it, and you're like, I got burned 3 years ago, I got burned 10 years ago, it's very important to analyze, why did you get burned? Did you get burned because you had some flaws in your decision-making process? Did you get burned because you just happened to buy at the absolute wrong time in 07? It would be sad for someone to miss out on what Steve and I and Jeff all agree is the best investment category you can be in because of an anomaly, really, right? You made a mistake in how you thought about it. You bought at the absolute wrong time or something like that. And some things you can't just control in life. Don't give up on real estate because you had 1 or 2 bad experiences, right?
Yeah, I totally agree with that, Wade. You got to get back up, keep pushing forward, learn from your mistakes. Because I knew a lot of people, flippers, who didn't lose money in 7, 8, and 9 because they recognized the spike. And they go, look, this deal either works as it is or I'm not buying it. And whereas 2 years earlier, they were like, hey, this is a marginal deal, but because of appreciation, it's going to become a great deal. There is some wisdom that you can put into these deals. And I think the wisdom right now is assume we're at the top, make sure the deal works if there is a slight dip, or don't do the deal.
Yeah. Another important caveat I'll throw out there, and I know it's not on this slide, but if you have multiple exit strategies, you can normally weather a tough storm. The best rental properties that anybody bought were in 07, 08, and 09.
Yep.
And if you were able to hold on to that property, if you could put it into a long-term loan, rent rates did not drop that much across the country. In Houston, they didn't drop at all, right? Rent rates
went up, wait.
Yeah, absolutely.
Yeah.
So you know, if you have exit strategies, if you work with lenders who can help you muscle through that, and sometimes you don't have to have a job. If you lost your job because of something crazy happens, there's other alternatives, right? Even in the higher end price points, there are ways to hold that property for a while and either sell it at a later date, or it may end up being a great cash flowing deal for you. So just don't panic, sell at a huge discount, and then forget about the real estate investment industry in general. I do know we need to get to this next slide, and everybody is talking about inflation. It's a very common topic out there. And this article that we found talks about, it's from Texas A&M, and they always put out excellent both Texas and national based real estate information, but they're talking about how it impacts housing affordability and kind of their analysis of what's going on. But they did state that residential construction jumped 12.3% since the beginning of 2021. So that's good, right? That shows that, hey, some of this demand will hopefully be met. But one of the interesting things that talks about here is year-over-year growth in home price appreciation, generally between 3 and 6%. In 2019, it was 3.5%, you know, on the lower end of the average. But then we had the two, you know, huge jumps that we've had, you know, measuring 20% in July of 2021. So that's obviously unsustainable in the long run, as this says. And their prediction is that growth will likely dissipate, but it is unlikely that home prices themselves will decline. Furthermore, the story may bear out differently for Texas than most other states, thanks to the state's strong population growth and increasing demand for home ownership. So I do think it's important. A lot of these statistics we talk about are national. Fannie, Freddie, all these are national predictions, but I think there's also nuance within those numbers, right? There's massive population growth from high tax, you know, more lockdown states, technically, to states like Texas, Florida, Tennessee. And I think that even if the market nationally were to drop, there's a good possibility that some of these other states where people are moving to rather than from, they could weather the storm a little bit better. So whatever national numbers you see, I think states that are low tax are probably going to fare better overall. And that's what A&M is saying as well.
So this is kind of just a neat chart that was tagged along on that article Wade was talking about from A&M. It talks about just kind of numbers, just putting it out there. How much is a house worth after 1 year of appreciation? And so, you know, as you can see, let's take a typical $300,000 house. In the market we're in, $300,000 house a year later was worth $360,000. Right, and that is a massive jump. And so I know that the rates are going up. They are still really, really low. Rates are going to go up almost for sure. If you have and you know, Steve, you can speak to this. A lot of folks that have a residence that's probably collected a ton of equity. You know, even if you bought it a year or two ago, you know, you put the typical down payment down. If you bought a $300,000 or $400,000 house and you want to get into real estate, there's a really good chance that you could do a cash out refi right now and probably pull out enough cash to get at least 2 deals. So, and if you think about that, you take that money, okay, yeah, your mortgage is going to go up a little bit, your payment's going to go up a little bit, but you take that cash, you buy 2, maybe 3 houses. You know, think of where you're going to be 10 years from now. When just assuming normal price appreciation, paying off a little bit of your mortgage, you're going to be in such a better shape financially with those 2 extra properties. Because as you acquire deals, you're gaining more equity, you're getting more cash flow. You know, it's a great way to really plan your retirement in the long run and be sitting on a lot of properties with a lot of equity. But the point of this, like I said, 1 year at 20%, you take a $300,000 or $400,000 house. If you just put a normal down payment down, you can almost surely buy at least 2 properties, maybe 3.
Yeah, Jeff, I'm sure a bunch of the viewers are now losing their minds because the poor and the middle class think you're supposed to pay off your home when that's considered dead equity. So listen to what Jeff is saying. We don't pay off our homes. That's a poor and middle class belief. That is called dead equity. In other words, if you have a $500,000 house paid in full, what I would do immediately if that was my house, I'd refinance it, pull $400,000 out, go buy an apartment complex that pays my mortgage and leaves me $100 grand a year profit. Yeah, debt equity, again, that's a poor and middle class belief that you pay off your home.
Mhm.
Next slide.
This next slide here is just talking about the home appreciation rate that Jeff has been talking about, but it stretches it out a little bit. I'm sorry, this is what is required to qualify for a home, my bad. So this just shows how much more money you have to make to qualify for a home whenever it appreciates as significantly as it has. And this can really impact people's ability to buy homes, but as a real estate investor, if you're looking at this chart and you are buying properties as a real estate investor and home appreciation continues and inflation continues, it makes it more difficult for other people to buy homes, which also means that there are potentially going to be more renters, right? So whenever these things happen, it's unfortunate if you're not one of the people taking the best action to survive and thrive in those environments. But people who own hard assets, especially real estate, whenever things inflate, you're normally not one of the ones holding the bag, because anytime of massive appreciation or massive inflation, homes have appreciated correspondingly in almost every previous incident. And this happens in oftentimes in other parts of the world as well, where hard assets and real estate are the things that thrive in those environments. So if you think it's an inflationary environment, and a lot of people do, this can be a great way to avoid that, because if you wait and you're not in real estate, and try to buy a home a few years later, you can see how much more it is going to cost to buy in the future. It's significant.
Yeah, the increased interest rates, it's just, look at the difference between, say, a $300,000 house, 2% and 20%. I mean, that's almost $20,000 in a year in income. That's significant. So eventually some of these buyers are going to get priced out. It's going to happen as rates go up. As rates go up and appreciation goes up.
Yeah.
So this is, like Wade said, this is the slide that kind of just extrapolates out this growth over a 5-year period. So I wouldn't assume 20% for 5 years, but somewhere between 5 and 10 is the norm. And if you bought a house the last year or two, it's probably a pretty good bet that you may hit the 10% average over that 5-year period, because you got 2 years almost sitting at 20%. So if you bought a house at $300,000, 5 years later, with a 10% appreciation, you're looking at 480, right? You see that chart there, 300,000 to 10% is 480. So it just kind of puts a visual to what we've been talking about, which is the more properties you can acquire, the better off you're going to be as properties appreciate, which leaves you a lot more flexibility to use financial products to go get more houses, basically.
So the next chart is a chart on historical interest rates, and people are often, you can't quite see the bottom of it. That's unfortunate, but I can tell you the range.
It goes from 71 to 2020.
Yeah, there we go. 71 to 2020. So a lot of people don't realize this, but they're in the early 80s. Interest rates hit 18%, right? It's crazy, but that was also a time when inflation was comparably high. So normally in times of high inflation, interest rates raise correspondingly. So we still have a golden opportunity at this moment in a high inflationary environment to lock into hard assets at low interest rates, which is an excellent opportunity. But some people called us up the last couple months. Rates went up a little bit from where they were a couple months. Should I wait a while to buy? Should I wait a while to refi? And whenever you look at things in context, historically, rates are still incredibly low. There's not been a time And if you go beyond the 70s, rates were never lower than that either. So this is an amazing time for real estate investors to use basically government subsidized money in order to get into real estate and make outstanding returns. So don't ever hesitate because rates go up a touch. And we should expect them to go up next year, but they're still going to be great to help you cash flow.
Yeah,
Steve, anything to add to that?
Yeah, I kind of look at it as anything below 4.5 is free money.
Yeah.
It really is. I mean,
Yeah.
3.3, that's not even inflation. Yeah, that's free money. You need to be taking advantage of these opportunities before the 1980s hit again.
Absolutely.
Take it easy. Hope it's not that bad. Come on. Let's, a little gentle increase. So, all right. So this is Houston data. So if you're on the phone and looking to invest in Houston, this is relevant for you. A couple of the highlights. The second bullet point I think was pretty important. Days on market fell year over year from 46 to 35. Total property sales were up almost say 5.5%, 6%, which is, I was kind of surprised, to be honest, because we hear about limited inventory, but there's actually more deals happening now than there was a year ago. Listings are down 13%, but that's normal over the last year or so. We've seen that pretty consistently. The reason why we've been able to sustain these high volume, high price numbers is the acceleration of it. So you may have fewer properties listed for sale, but they are selling at a much higher clip, meaning the percentage of deals that are available are closing much higher now than they were a year ago or 2 years ago. Average price, wow, the average price for single family home in Houston last month was $383. That's up 13% from last year. And the median price, which would take out a lot of those high-end numbers, is still $314. So a 16% increase. Months of inventory down to 1.6. That again, as if you're new to this, 6 months is considered a balanced market, right? So 1.6 means that if no other properties hit the market, it would take a month and a half basically for every property to sell. If you look at rents, the rentals rose 7% with the average rent up 8.5% year over year. Excuse me. It's at roughly $2,040 in November, which is a little bit down from October, but as Destiny pointed out in our conversation we had yesterday, rentals are a little seasonal. So this is kind of a slower time of the year for rentals. But if you just look at the overall trends, just look at pre-COVID, the average was $1,768 February of 2020. So if you started investing pre-COVID, your rents have gone up $300-400 a pop.
And relative to the total rents, that does not sound like a huge number. I mean, it is a big number, don't get me wrong. But when you think most properties are cash flowing $300-400, that is a massive increase to cash flow, which is what is most important to you. So that's a very exciting number overall.
I mean, think about it. You bought a rental property, you were making $300 before COVID. You didn't do anything, but now you're making $500-600, right? Literally, you're able to take that exact same property and rent it for almost twice the profit.
That's interesting because that's the same exact thing that happened in 7, 8, and 9. We were having rental increases, $100, $150 a month. That was happening annually. I mean, I went from one little house out in Katy, started at $1,500. By the time it was said and done, it was $1,750. And I think the person who bought it from me leased it for $1,950. Yeah, the cash flow just keeps going up. It really does. Even when prices drop, the cash flow keeps going.
Yes, no doubt about that. Next slide.
I'll cover this next one so you can do San Antonio. So this is just year over year, broken out by housing segment. We always just kind of look at this and see if it's going to change anytime soon, and it hasn't. If you look at those first 3 segments, 0 to 100, 100 to 150, and 150 to 250. All three have seen significantly less units sold since last year because there are just frankly less properties available at those price points. And then conversely, as prices go up, you see starting at 250 and all the way above $1 million, that 500 to 1 million is an obnoxious increase, 50%. So a lot of properties are hitting that price point that weren't there a year ago. And then $1 million over, still up 20%. So anything 250 and above, a lot of properties are falling in that range.
So San Antonio, another area that we think is an excellent market in which you can buy rental properties because of the relative affordability compared to the other major metros like Dallas and especially Austin. But the total number of sales were down a little bit last month, but year over year, average price up 17%, slightly above where Houston just showed a little bit ago. A very interesting thing is that their rents went up year over year, whereas Houston went down a little bit. So despite seasonality, you see the rents went up 8% in San Antonio. That's a strong indication of a very strong rental market. And then if you also look at the days on market comparison, days on market down 36% from a year ago on sales and down 18% from a year ago on rentals. So San Antonio still seems to be very strong and maybe a little bit less affected by the seasonality in the rental market, maybe a little bit more in the sale market, right? That's two things we see there.
Steve, are you guys doing deals statewide or primarily in Houston?
Well, we have nationwide, but I would say 80+% of the deals are Texas. Probably 70% of that 80% are all greater Houston. But yeah, we're doing a lot in Dallas, Fort Worth, a lot in San Antonio, a few in Austin, but it's really the surrounding communities, not in Austin. And then we've got a couple of guys killing it in Florida, killing it in Orlando, Atlanta, Phoenix. So yeah, just
what are they buying out there? They're buying single family or apartments, or what are they buying?
Both. So we've got some single family and then apartments as well.
Nice. And
self-storage. We're buying 5 complexes in New Mexico right now.
Wow. It's exciting.
Yeah. All right, Dallas. So more of the same, right? The median price in Dallas, and this is in the North Texas area. So if you notice, the numbers are much higher, say, than Houston as far as volume, but that's because it's including the entire North Texas Metroplex area. So median price is $315,000. I do like the little report they do. They kind of do a price distribution to show where the houses are selling. The other one in Houston shows increase or decrease percentages, but Dallas shows where the meat of the deals are. And if you look at that, 50% are between $200,000 and $400,000. Then it kind of goes from there. Listings were up 18%, which I thought was an interesting stat. Closed sales were down a little bit, which doesn't surprise me. I do think 13. Okay, you look at days on market, 72 days on market, which is down 13 days. So by using the same metric, they're at 32. Houston was at 35. San Antonio was at 32. So it's very similar in the days on market. I did want to point out days to close was 40. So that's basically the amount of time it's taking for them to process and close the mortgage, right? For a long time now, the real estate market has been so busy. Appraisers, there's one group of people that are feeling a lot of that brunt are the appraisers. So because of that, there's only so many appraisers to go around and more transactions. So it really has put a lot of pressure on closing times. It just takes longer now to do a mortgage than it did in the past. And primarily it's because there's a shortage of appraisers out there. So Dallas is interesting. They give you, and I think Wade found an article a little while ago that showed something pretty similar on how long it takes to process a mortgage these days. Months of inventory, they're down to 1.4, which was one, and compared to 1.9. So it's very similar to Houston stats. I think Houston was 1.6 or 1.4. So when you consider the entire Metroplex area, it's very similar to Houston's.
Yeah, to add to Jeff's point on time to close, I saw the national average from Fannie, Freddie, VA, all the government backed entities was 47. Was the number that I saw on a national basis. So it seems like Texas, Dallas, I'm not sure exactly where they're pulling their numbers from. If it's pulled from MLS, there may be some slight differences in those numbers, but
maybe some cash deals too.
Could be, yeah. All right, Austin, which has been without question by any measurement the hottest market in Texas and probably arguably the country. It's just incredibly hot. The numbers are amazing. Median sales price up 29% year over year. Closed sales up 23% year over year. I mean, we saw not a huge increase in total volume because of the seasonality in some other areas, but that's still not having an impact there in Austin. Days on market down 13 days over last year, which was still an incredibly low number. Total volume still up 6% year over year. Months of inventory down another 0.1 months down to 0.8. Like that's an incredibly low number. And new listings are still up. It seems as though that was a little bit surprising to me. We see listings, most of the other markets, correct me if I'm wrong, Jeff, we saw listings down like in Houston and some other places, but
definitely Houston.
I think it's interesting that their listings are up there over last year. Active listings, new listings are up, active listings are down because they're pulling so much of them out. Pending sales up 7%. So it's a very, very hot market there. And what's interesting, if you don't, I'm sure Steve feels the same way, like this is a more difficult area to own rentals for sure. And it is a more speculative flip market because a lot of people are betting on the come in order to get into the market and be able to buy a property. They're expecting some appreciation there. I know some people who've done very well there, but it is a more aggressive play. But we do see some people who do well in that, duplex to quadplex or small apartment market there. That is a market where we've seen some people do some strong numbers. But the single family rental in the major metro part of Austin is definitely challenging. Steve, what do you guys think?
That 22 days is really, really low compared to the rest of the markets in Texas. That's a fair 10 days less.
Yeah, in answer to your question, Wade, when I look at that median sale price 470 and everybody else is around 315, 325, 330, you can just see there's some exuberance in Austin that's just somewhat ludicrous. Dallas is just as beautiful a city. Houston is awesome. San Antonio is awesome. It doesn't make sense to me. And those things are not going to produce positive cash flow at that price. So you're going to have to go to the surrounding areas and get down below $300,000 before you start seeing any significant cash flow. I'm telling my students 150 to 250 ARV after repaired value is where we stay for our rentals because those things produce $300, $400, $500 a month cash flow. These things are not. So that's why we're staying out of Austin Round Rock.
That's a great point. We see a lot more deals come across our desk in those tertiary markets that are not quite in the city. They're adjacent, right? A little more rural. So when you do find those deals, it takes a little bit longer to get them closed because there's not only so many people that are in that business in, say, College Station or whatever. But to your point, though, that's where you can find some really good deals. All right, so this is the Affordability Index. We try to include this on every market update. It's basically a measurement of if you were to live in this city, what percentage of the average household income would go towards making the typical mortgage payment. right? And so if you look at the top 5, no surprise there. New York, Miami, LA, Long Beach, Newark, New Jersey. I will say, and then Austin's 20th. We highlighted all the Texas markets. Houston is up 5 spots, right? So Houston is starting to creep up there in the rankings. Still very good place to buy rental properties, don't get me wrong, especially when you consider how big a city Houston and Dallas is. But it is starting to creep up there into the 20s, right? The top 20 markets. You know, if you look down at, like I said, the tertiary markets, some of the San Antonio's great value, right? 60th. Garland, Corpus, even Lubbock down there. It's way down there, 95. That's where you can really find some nice cash flowing deals if you can find the properties. But I always think it's interesting to see kind of where the big 3, Houston, Dallas, and Austin, are relative to the rest of the major cities out there.
The first thing that comes to my mind, Jeff, look at New York. 84% of your money goes just to live there. And the sales pitch is, but New York's so fantastic. Yeah, but you got no money to enjoy it. You don't have money to go out to dinner. You don't have money to go out and romance your spouse. You're sitting at home watching TV if you're in that situation. Yeah, I can see why those people are moving to Texas.
Yeah.
Sure.
And these numbers this is gross household income. This is not net household income. So if you have an extra 12 or 13% state income tax like California and New York do, then that's another big reason to move to cities that are different, but also great job market, right? Cultural opportunities, museums, restaurants, nightlife. I think that's why we're seeing such a big push, and why the home prices are growing at a very rapid but reasonable pace, honestly, for Dallas, Houston, and San Antonio. I think it's still somewhat reasonable because we're below the national average. The place where it seems unreasonable to me, despite all the tech companies moving there, is Austin. That number is really, really high.
Yeah.
All right. Time for questions, Destiny?
Yes, once I pop up, you know it's time. Just to recap though, we will be sending you guys a recording of this webinar. We're going to do our giveaway and then we'll jump into questions. If you haven't asked your question yet, use the question box to go ahead and write it in. I'm going to be going in order. And then if you have a very deal specific question, I will take your information and send you to one of our fully licensed loan officers so that they can analyze that deal specific and help you guys out. And as another reminder, Steve has his next event, which we will be sponsoring, so you can come out and meet some of our teammates and see one of the best networking events I've been to, and just participate in that, hearing from that amazing speaker. And that's going to be next Thursday on the 16th, and it will be at 6 o'clock. If you guys want the address, we can include it. I'll just go ahead and include it in your email tomorrow for information on that. I'll send the link that you mentioned earlier with the /spotlight. Okay, great. Well, our very first question, yes, sorry.
I was just going to say, and on top of doing a great job of presenting good information, they do a great job of having fun events. I always have a good time at their events. It's educational, but it's always a fun evening.
I've had too good of a time at their events. So our first winner of the year for half off your hard money processing fee. Drum roll. I am so sorry. I'm going to probably mispronounce your name, but I have your email, so you will get a confirmation. Rahavendra Chinoy, congratulations. First winner of the year. Half off your hard money processing fee. I will send you an email confirmation so that you have all the information and next steps. Okay, Steve, our first question is for you, and it goes back to the very beginning. You mentioned a book on multifamily investing. Actually, one of our awesome investors that works with us is asking, what was the name of the book again?
You know, I'm going to step out of the camera for a second.
You
because
grab
I have a copy on my shelf.
Great.
Of course, because it changed my life. It's
This is exclusive content, guys.
Why am I backwards? It's the complete guide to buying and selling apartment buildings. The complete guide to buying and selling apartment buildings by Steve Burgess, B-E-R-G-E-S.
Awesome. Okay, guys, I hope you took notes, but if you didn't, that's okay because this is recorded. You'll get a copy tomorrow. Thank you, Steve. Our next question, any one of you could answer. It's not directed to anyone specific. This one's a little long, so I'm going to break it into two. The first part of the question is, do you think values will be more likely to increase if inflation levels off?
I think if inflation levels off, inflation will not be driving the appreciation, but there are other factors, normal supply and demand factors, that could continue to cause home prices to increase. But inflation kind of operates outside of those other factors, right? Because just the way that inflation, the nature of it. So I think that there's a lot of factors that caused this 20% last year. Inflation was just one of them.
Low interest rates was definitely a big part of it, and the millennials coming of age and starting to buy houses, those were like really big factors if I remember. Now the second portion of this question is, are there any other factors besides the anticipated and non-anticipated rate rises that could hold values down?
Steve, why don't you take this one? I know you have a couple thoughts.
I think, you know, it depends on how many of these homes that are in forbearance they actually allow to get foreclosed, if that's still going to be a factor. I still think that there's the worry of people waking up and realizing they're overpaying for these houses, and then it shuts down. Those are the only two major factors that I can think of. But that fear, people need to take that seriously. That is a real thing. It happened in 2007 and 8. It could happen again.
It is interesting. Momentum is powerful in two directions, right?
Yes. Both positive and negative.
Yep.
Awesome. Thank you, Steve. Our next question, this is outside of the Texas area, but they are asking what we think about Florida and Alabama for investment opportunities.
Let me address this one, please.
Sure.
Okay.
These are speculative questions, and they're not really investor questions. Now, bear with me. Meaning, if you're looking outside your community where you live to invest, you're more of a speculator than you are an investor. You're trying to crystal ball it and pick the best cities and the best states and all this. I think that's garbage. I think that you can go right in the community where you're at. And if you're focused on cash flow and you know how to analyze deals properly, and you've got somebody like Catalyst Funding checking your numbers and making sure that the deal is right, which they do, by the way, you need to invest in your community. I have never, oh boy, let me be careful and think. Nope. Every piece of property I've ever bought was within 30 minutes of my home. And I had 4,000 apartment units at once. So be cautious of people who sell you on speculating, trying to figure out which part of the country is best. You can fly me to any city, anywhere in the country, drop me off, and I'll make money in that city with real estate.
All right. Thank you, Steve. My next question is in regards to duplexes. This is, what are your thoughts on duplexes in Dallas? Thinking about house hacking by living in one unit and renting the other as an Airbnb, which we have a really great Airbnb loan product. So Jeff, do you want to take this one?
I think in general, like you said in Austin earlier, for sure, as you get into higher prices, duplexes, triplexes are definitely a good strategy to have. Your cash flow is significantly higher if you can find those good deals. You know, depending on where they're at, they may be a little pricier, right? 3-4 units might cost you a little more money, but on the whole, duplexes, triplexes, especially in more expensive environments, are a great way to pick up some extra cash flow.
I also
Awesome.
like the idea, Jeff. I agree with Jeff that house hacking a duplex makes sense. I don't like people house hacking single family houses, but a duplex, a triplex, a fourplex, and then to learn the business of Airbnb for free, that's not a bad deal, because then after you get good at running that little single Airbnb, you can go run 100 Airbnb.
And one of the tools for that I think the person's referring to is like maybe using FHA financing, because FHA, as long as you live in one unit, you could
Yes.
buy a 4-unit, right? And we have those products available if somebody wants to talk about those. But those products do allow you to put arguably the lowest down payment around into them, right? So that can be a very attractive option if you want to get started and you're willing to live in close proximity to tenants or even vacationers. You know, that is a little bit of a different lifestyle at times, I'm sure, but it can be a great way to get into the game.
Awesome, thanks guys. It was just brought to my attention though by our office manager that I have a small typo here. It's next Thursday, and Thursday is the 13th, not the 16th. Don't worry, I'm going to send you guys the information, but I just want to clarify in case anyone was writing that down. Our next question is, do you have any more information on College Station rental market or any other college towns? What would be anyone's opinion on those areas?
I know a lot of people that do very well in college towns, but it's no different than any other city. You've got to run your comparable sales. You got to run your comparable rents. It's just analyze the cash flow. Don't think just because it's a college town, they're going to be leased. You look at the environment, analyze your deal correctly, and you can invest in college towns or in any town and make money.
Great, thank you. This question, I might try to jump in a little bit on, but this one is, you mentioned rentals are seasonal in the Houston market. What is the peak season for rental increase? And what Jeff was referencing earlier is something I noticed from my time in property management. People don't move very often during the winter time, and I purposely move during the winter time to secure the good deals. Just in my personal experience, I see it picks up a little bit more around spring and summer. Would you gentlemen agree with that?
Yes.
Or have a different opinion?
No, I'm not going to argue with that, but I do love your wisdom of going to look for rentals in November, December, because you get great deals. And I used to, when I had 100 houses, I would literally have some of my leases end in November and December, simply because everybody else got out of the market. They shut down.
Mm-hmm.
People say you can't lease in November and December. I leased in November and December easily because I was the only one working.
Exactly.
So don't be afraid of leasing your homes in November and December because everybody else is hiding from it. And then, like Destiny said, if you're looking for a place to lease, that's a good time to do it.
Awesome. All right. And yes, somebody did pop up. Yes, you are correct. It is the 13th, not the 16th. That's my typo. I'm 2 for 2 today. It's the beginning of the year. I'm going to take a little time to rest maybe. Let's see. And that actually concludes our questions. I have one more. Just a few people are saying, thank you for the great job. Thanks, Steve, for joining us. And yes, congratulations on winning. And she says, I hardly win raffles. Well, you won today. Well, that concludes our first webinar for 2022. We want to thank you guys so much for joining us. As always, make sure you like, subscribe, and stay in touch. We always inform you about really awesome events like the one Steve's having next week, and we'll keep you up to date with relevant information in the market. Thanks for joining us today, Steve. Thank you, Wade. Thanks, Jeff.
Thank you.
Thanks, Steve.
Thanks, everybody.
Thank
All
you.
right.
Happy New Year. Yes.
Bye-bye.